Is Indian startup funding making a comeback? Indian startups raised a jaw-dropping $13.7 billion this quarter. Sounds like the funding winter is finally over, right? Well, not so fast. Because while the money is back, it's not being handed out like it used to be. Investors are getting pickier, founders are facing new hurdles, and a few sectors are quietly dominating the game. Today, we are unpacking the real story behind India's Q1 2025 funding surge. Who's getting funded, who's getting left out, and what it all means if you're building or backing a startup right now. Let's start with the big picture. According to EY, $13.7 billion in PEVC investments flowed into India in Q1 2025 across 284 deals. That's a sizable chunk of capital. But here's where it gets really nuanced. Whichever way you slice it, overall funding is down about 14% compared to Q1 last year. Deal volume is also off by around 20%. But here's the twist. If you remove infrastructure and real estate, core startup funding, pure PEVC, is actually up 62% year over year to $10.9 billion. So while the overall investment pie might look smaller, the startup slice is getting bigger. And that's an encouraging sign. Alright, so let's dig into what this means on the ground for the startups themselves. Startups in India raised around $2.7 billion in Q1 2025 across 167 deals. That's up 66% year on year, which is huge. Inc. 42 even pegs it higher, $3.1 billion, which is a 41% jump. Now, quarter on quarter, there's a slight dip compared to Q4 2024. Some sources show a 4 to 7% decline, but Traction shows a 13.6% rise in tech startup funding. So, what do we take from that? The bounce back isn't perfectly smooth, but there's a consistent upward movement, especially compared to last year in the tech startup space. Okay, so funding is growing, but where is it going? Let's look at some of the major sectors who have absorbed the bulk of the funding. Tech continues to lead. EY puts tech deals at $3.1 billion, and venture intelligence lists IT services at $3.8 billion. Healthcare and life services came in strong with $1.1 billion. The post-pandemic momentum is still very real. Financial services brought in $1.6 billion, while food, agri, and FMCG also showed steady interest. One standout, auto tech. Traction shows $1.1 billion went into this space, almost 10x from Q1 last year. So, if you're building in deep tech, agri, mobility, or health, there's clear investor appetite. Late stage deals saw a big jump, more than $1.8 billion raised. So, yes, growth stage companies are back in favor. Seed and early stage funding is a mixed bag. Fewer deals, but not disappearing. Investors are cautious, really cautious. Smaller check sizes, tighter filters. And especially what happened with BlueSmart right now, investors are becoming not just more cautious regarding the investments, they are adding new investment protection clauses in the term sheets so that they can protect from such kind of mishap happening with their portfolio companies in the future. So it's not that the early stage startups aren't really getting funded. It's just that investors are doing more due diligence, expecting clearer traction before writing that first check. So who's cutting the checks? The biggest deals which happened this quarter, Bain Capital invested $508 million into Manipuram Finance, which is a huge investment. And as you can see, it was essentially over 15% of the total PEVC investment happened in this quarter. KKR put another $400 million into Healthcare Global. So these are the examples of the major deals. And as you can see, most of the private equity and VC deals, they are happening in very short, small numbers, but the ticket sizes are huge and which are beyond Series C and Series D stage. That is where a bulk of the investment is happening. Innovator and Kedara also made headlines, but the real action and the real progress happened in the venture debt space. Stride Ventures made 27 deals, Altiria Capital did 26 deals, Bloom Ventures was one of the most active early stage VC, which stayed active with 21 early stage VC deals. This shift towards venture debt tells us that startups want capital but without heavy dilution. And lenders are now available for growth stage startups. But this also means that startups are increasingly more comfortable taking debt, and they want to ensure that the investments and the business growth is more sustainable and financially and economically viable, and they are not spending for growth at all costs like it used to happen in 2021. Now let's look at the macro signals and the global context. So let's zoom out and we look at the global conditions which are still heavily impacting how the investments take place. Obviously, the number one factor right now is the tariffs in the US. Now, even though the tariffs are temporarily paused, last quarter when the tariffs were still active and Trump was going all in on the tariff war, that was primarily the reason why the Q1 funding actually went down. But now it's paused, you never know. But at the same time, the investors will still be in a pause and a wait and watch mode right now rather than actively deploying big capital. Geopolitical tensions, particularly the dastardly terrorist attack in Kashmir last week, is going to play a significant role going forward because people would be trying to wait and watch what the Indian government's reaction would be to the dastardly attack which happened last week. Couple that with the choppy IPO markets, most IPOs this year haven't performed well, and that has completely dampened the mood towards IPOs for this year. But certain sectors like health tech and fintech, they remain extremely resilient. They're no longer just trendy, they are foundational. One concern, deep tech is still significantly underfunded. AI is buzzy, sure, but hard tech, IP-driven businesses need more backing. So, what's next? The rebound seems real, but measured. Investors are focused on quality, not hype. You're still seeing big bets, but only on companies with solid metrics and clear market demand. You can expect more late stage capital happening like Series B, Series C, and beyond, more venture debt, and increasing appetite for businesses with sustainable unit economics. Q1 2025 shows that India's startup ecosystem is evolving. Less froth, more fundamentals. And honestly, that's a good thing. Startups that are solving real problems, operating lean, and building for long term value, they are the ones who are winning in the current venture funding cycle. If you're building, investing, or just watching the space, this is the time to stay sharp. Let me know in the comments what trends are you observing in the sector, and if you found this breakdown helpful and need more help raising capital, check out the video in the left. I'll show you in more details how we help in raising debt and equity to a lot of early stage startups. Hope you had a good day. All the best.